Welcome to the Efficient Private Clients Quarterly Update. Today we're joined by Etienne Viljoen, our Chief Investment Officer. He'll be answering some questions for us on the quarter. Etienne, global markets had one of the best starts since 2019, with the S&P and the likes up by close to 10%. What are some of the main reasons for this?
Yeah, well, I think it was a bit of follow-through from the fourth quarter, purely momentum. And then also the good earnings season created by the AI hype, that it almost created a fear of missing out attitude from investors. And then also economical data that came out stayed resilient, showed that the US consumer is staying resilient, and it created a feeling that maybe the US can avoid recession before the rate cut cycle starts.
Okay. If we look at the likes of the Magnificent Seven, they obviously had a great 2023 and contributed to this first quarter rally. We noticed that two of them, being the Apple and the Tesla, were a bit of an anomalies there. Do we see this as a bubble?
Now look, I think in that seven companies, it's quite vastly different companies, even though they are always mentioned in one group. I think NVIDIA had very good results. It basically justified its rally. Question is now just how much is priced in going into the future, whether it's not too much. So it might be a bit risky getting into that now, but there is still justification for a lot of the rallies. Apple, yeah, they abandoned their plans to create their own electric vehicle. iPhone sales really started stagnating and plunged in China on the back of a weak consumer and also increasing competition. And Apple down by 11% compared to NVIDIA's rise of 80%.
Yes.
And then Tesla came down more than 30%. I think also sluggish EV sales and then also Chinese competition. I think that Chinese competition word is coming up quite regularly now. That's definitely, they had to cut prices and that's weighing on them. So I think it's not a bubble in terms of 2001, where this rallies have been backed by earnings mostly. But I think one just need to be careful for new money, see what's priced in that. In the long run, abnormal profits can't last and competition will come to the party.
Definitely. Okay, so how do we see emerging markets and the likes of the JSE reacting to the US interest rate expectations?
Yeah, well, I think we started off the year with the consensus was 7 interest rate cuts in the US, which we all believed was a bit optimistic. Then inflation data didn't show a decline as fast as the Fed probably would have liked, so everything's been postponed a bit. That kept the dollar strong and weighed a bit on emerging markets. The overall emerging market index still ended positive, but lagging developed markets. Chinese market was down more than 10% at one stage, but during March, aggressive stock buying by the Chinese government started giving support, and then that triggered some foreign inflows as well. The JSE was down by 4% for the quarter, and one of the big laggards was MTN. They make most of their money in Nigeria, and the weakening Naira weighed heavily on their earnings. Pick n Pay was another one, down by more than 20% on the prospects of a rights offer. And then overall, the resource sector, which is the biggest, struggled during the quarter.
Okay, touching on the resource sector, we saw gold and oil were standouts while there was pressure on the rest of the commodities. What are the reasons for that?
Yeah, I think geopolitical tensions on gold, the feeling that inflation will remain probably a bit higher for longer, and rates can also remain a bit higher for longer. A feeling that the US dollar is very close to a peak, so that all helped gold. Oil, again, geopolitical tensions, I think that comes up every time. And then the drone attacks on Russian refineries, and then also OPEC, which is looking like they'll keep cuts in place at least until the middle of the year. And lastly, sort of perfect storm, that the refining margins also increased a lot, so that creates an extra demand for oil.
Okay. And we saw that the rand lost some early ground against global currencies, such as the US dollar. What do we expect in terms of currency and interest rates going on for the rest of the year, or at least for the next quarter?
Yeah, well, I think volatility and uncertainty, especially on the rand, running up to the election, which is now just more than 2 months, well, less than 2 months away. I think that is definitely going to be one of the biggest events in the last 30 years. Usually we always say that external factors play the biggest part in the rand, and that local politics aren't that important, but this time around it might be a bit different. So overall, boasting well for emerging market currencies, I think, but it will be difficult to see the rand moving a lot before we have certainty after the elections.
Yes.
The Reserve Bank should be quite conservative, I think, in waiting to cut rates to see what the Fed does, even though we have very high real interest rates. Can't see them cutting before the Fed makes a move.
Okay. Is there anything else outside of elections that we can see happening in the second quarter of this year?
Yeah, well, locally, and as I said, it's looking like the Chinese market, there's a very good chance that the Chinese market have bottomed. And also in recent weeks, the resource prices started recovering.
Yes.
People are betting on the fact that, as I mentioned, the dollar might have made a high, and that can be good for emerging markets and resources. 50% of the JSE is made up of resources and Naspers, and China is the biggest influencer. So out of that point, it's looking fairly optimistic. Okay. The SA Inc. companies, that will depend on what happens in the election. Yes. And on the local currency. So I think that, again, we'll see a bit of reluctance before there's certainty in that. But overall, more positive than negative on the local market. Globally, I think more volatility, big focus on data, interest and inflation expectations as they change and move along. So on the big companies, like we mentioned, the mega cap stocks, the Magnificent Seven, I think there's going to be a dispersion in returns, that it won't necessarily be all the companies that's doing well, but the ones that's actually employing their capital well. Yes. It's definitely, even though the base case is that we'll see interest rates lowered, and lower interest rates should create a tailwind for equities. We're definitely not moving back to a negative interest rate environment or a sort of free money environment. And I think in terms of that, stock picking will be important, as preference will be given to companies employing the capital most efficiently.
Okay, perfect. Thank you, Etienne. That was very insightful. Until next time.
Thank you.